It starts with a sound you don't hear in startup lore. Not a boardroom shout, not a slammed door, just the soft click of a mechanical keyboard stopping mid-sentence. November 14, 2018, 3:17 a.m. The office is empty except for one man sitting at a corner desk, the glow of a dual-monitor setup reflecting off his glasses. He deletes the final paragraph of a product roadmap. He closes the laptop. He places his employee badge on the glass surface. He stands. He walks. He leaves a paper trail worth $400 million on the chair behind him. Nobody notices until morning. By then, the security system has already logged his exit. The company, a rapidly scaling data logistics platform called Axiom, continues humming. Servers cycle. Code compiles. The IPO filing moves forward on schedule. But the architecture has already lost its center. The media will later paint him as a footnote. The documentaries will Leoneize the founder who stayed. The financial press will call him a cautionary tale about timing. They are all wrong. He didn't miss the window. He stepped out of it. Axiom was born in a damp co-working space in 2012, built by two 20-somethings who shared a single whiteboard and a different understanding of why technology should exist. Julian saw friction. He saw fragmented supply chains, delayed shipments, wasted capital, and an industry drowning in spreadsheets. Marcus saw trust. He saw small manufacturers, regional distributors, and family-owned logistics firms trying to survive in a system that treated transparency as a liability, not a feature. They coded the first prototype in 6 weeks. It connected buyers to verified sellers, tracked inventory in real time, and replaced handshake deals with auditable digital records. It worked. It spread. By 2014, venture capital noticed. By 2016, they were processing $3 billion in annual transaction volume. The narrative was simple. Two founders, one vision, a rocket ship trajectory. As shown in the 2016 TechCrunch feature, the photo captures them standing shoulder to shoulder at a product launch, both wearing the same black t-shirt, both smiling at the exact same camera angle. It looks like harmony. Watch that same footage with the audio unmuted, however, and you catch the first crack. When asked about user data retention, Julian answers in 30 seconds about market dominance and network effects. Marcus takes 8 seconds longer. He talks about consent boundaries and system integrity. The pause isn't hesitation. It's calculation. The question is whether they realize they're already answering different tests. The shift arrives quietly. Series B funding brings institutional expectations. Institutional expectations bring pressure to monetize. Monetization brings a proposal buried in a Q3 2017 strategy deck. Behavioral data licensing. The idea is straightforward. Axiom already tracks shipment patterns, pricing fluctuations, and vendor reliability. If they anonymize and aggregate that information, they can sell predictive insights to hedge funds, real estate developers, and retail chains. Julian presents it as natural evolution. The platform's value isn't just in connecting parties. It's in knowing what they will do next. Marcus reviews the technical architecture. He reads the data flow diagrams. He sees the default settings change from opt-in to opt-out. He sees the privacy dashboard shrink from 3 pages to 1. He doesn't argue in meetings. He documents. As shown in the internal engineering memo dated August 9, 2017, Marcus writes a single line to the infrastructure team. If we remove explicit consent, we break the foundation we built on. The system stops serving users and starts mining them. The memo is acknowledged. It is not acted upon. The product ship date remains fixed. The licensing agreement is drafted. The revenue projection jumps 40%. The board applauds. Marcus stops attending Tuesday strategy sessions. He starts working from home. He tells no one why. The isolation grows in silence. Julian hires a new chief product officer with a background in ad tech and behavioral economics. The onboarding meetings run long. The engineering stand-ups shift focus from system reliability to engagement metrics. Marcus watches the code repository change. Pull requests that once prioritized data encryption and audit trails now prioritize tracking pixels and retention hooks. He submits counterproposals. They are marked as low priority. He requests a formal ethics review. It is deferred to post-IPO. He stops submitting proposals. He starts building a parallel system in his spare time. A stripped-down version of the original Axiom architecture. No data licensing. No behavioral tracking. No hidden defaults. He calls it Axiom Core. He doesn't pitch it. He doesn't register it. He just builds it. As shown in the timestamped commit history from October 2017 to January 2018, his personal repository grows steadily, while his corporate access logs show a sharp decline. The pattern is clear. He isn't sabotaging. He is preparing. He knows what happens when a company's revenue model depends on extracting value it promised to protect. He has seen it before. He just never thought he would be standing inside it. The breaking point doesn't come from a fight. It comes from a calendar invite. February 12, 2018. 10 a.m. Boardroom B. The agenda lists one item: pre-IPO data monetization rollout approval. Marcus walks in. He sits. He places a printed copy of the original 2012 founder agreement on the table. He points to paragraph 4. All data collected remains under user control unless explicit. Separate consent is granted. Julian doesn't argue. He explains market reality. He mentions competitive pressure. He notes that every major platform operates on similar models. He says the IPO valuation depends on scalable revenue streams, not philosophical boundaries. He says they can add transparency later. Marcus listens. He asks one question. If we sell what we promised to guard, who are we serving? The room stays quiet. The legal counsel adjusts his pen. The board chair checks the time. The vote is scheduled for Friday. Marcus doesn't attend the Friday meeting. He submits a formal separation request on Thursday night. He declines the accelerated vesting clause. He waives his board seat. He signs a non-compete that limits him to academic and open-source work for 3 years. He leaves $400 million in unvested equity on the table. He packs a single cardboard box. He takes his personal laptop. He walks out the glass doors at 6:43 a.m. The security guard nods. The turnstile beeps. The building absorbs his exit without a ripple. The media never captures the moment. There is no press release, no farewell email, no viral resignation post. The official statement reads like standard corporate hygiene. Marcus has decided to pursue personal projects. We thank him for his foundational contributions and wish him success. Julian takes the stage at the IPO roadshow in March 2018. He talks about scale, about disruption, about redefining logistics. The valuation hits $12 billion at opening bell. The stock climbs. The headlines celebrate the founder who stayed. The documentaries film the office. The cameras pan over the original whiteboard. They show the early photos. They replay the 2016 launch interview. They don't mention the missing chair. They don't ask why the co-founder vanished. They don't trace the architecture changes. They treat the split as natural attrition. As shown in the 2019 Fortune cover story, the narrative is clean. 2 partners, 1 vision, 1 grew up, 1 stepped aside. I've read that article 3 times. I've compared it to the engineering logs, the board minutes, the data flow diagrams. The article isn't lying. It's just omitting the gravity. Success in tech isn't measured by who stays. It's measured by what you're willing to trade to stay. Julian traded control for scale. Marcus traded wealth for coherence. Neither is right. Neither is wrong. They just chose different currencies. The aftermath unfolds in slow motion. Axiom launches the data licensing product in Q2 2019. Revenue spikes. Enterprise contracts multiply. The stock holds steady. Investors praise the execution. The engineering team grows to 400 people. The privacy dashboard remains a single page. Marcus disappears into academia. He accepts a visiting fellowship at a European university. He teaches systems architecture. He publishes 2 papers on transparent data governance. He doesn't mention Axiom. He doesn't need to. The work speaks in principles, not names. He builds open-source modules that prioritize explicit consent by default. He releases them under permissive licenses. Developers download them. They integrate them. They fork them. The community grows quietly. No funding. No press. Just code that behaves exactly as promised. As shown in the GitHub repository analytics from 2020 to 2023, his projects maintain a steady stream of contributors. The commit messages are short. The documentation is precise. The issues section reads like a masterclass in technical clarity. He isn't trying to compete with Axiom. He's proving a different model can exist. He's showing that restraint isn't weakness. It's design. The first tremor arrives in 2022. Regulatory scrutiny tightens. Data privacy laws shift from guidelines to enforcement. Axiom's licensing model faces audit requests from 3 different jurisdictions. The legal team scrambles. The engineering team patches. The stock dips 4%. Julian goes on a media tour. He explains the safeguards. He emphasizes compliance. He notes that all data is anonymized. He avoids the word consent. He doesn't mention the 2012 founder agreement. He doesn't mention the original architecture. He talks about adaptation. He talks about scale. He talks about the future. The cameras capture his confidence. The transcripts capture the deflection. Watch the 2022 CNBC interview closely. When asked about user control, Julian's response takes 12 seconds longer than his average answer. His hands stay flat on the table. His eyes shift to the interviewer's shoulder. It's not guilt. It's calibration. He's recalibrating a narrative that no longer matches the legal landscape. The foundation is cracking. Not from hackers. Not from competitors. From the exact compromise he called necessary. The second tremor hits in 2023. A whistleblower files a complaint with a Federal Trade Commission. The complaint cites internal emails. It references the 2017 data flow changes. It names the shift from opt-in to opt-out. It includes timestamped server logs showing user behavior patterns sold to third-party analytics firms. The complaint doesn't accuse Axiom of illegal activity. It accuses Axiom of systemic deception. It argues that the platform's original promise was abandoned without clear user notification. The legal language is precise. The evidence is documented. The impact is immediate. 3 enterprise clients pause contracts. 2 regulatory agencies open formal investigations. The stock drops 11% in a single trading session. Julian addresses shareholders. He promises transparency. He announces a privacy overhaul. He hires a new chief ethics officer. He pledges full compliance. The statement is clean. The timeline is tight. The market stabilizes. But the architecture has already lost trust. Not in the code. In the company. As shown in the 2024 User Retention Report, active merchant accounts dropped by 18% year over year. The data isn't dramatic. It's quiet. It's steady. It's the exact pattern Marcus predicted in a 2018 internal draft that was never sent. The draft reads, "When trust is treated as a friction point instead of a foundation, the system will grow until it collapses under its own weight." He didn't send it. He didn't need to. The numbers delivered it for him. The irony isn't that Marcus walked away. The irony is that everyone assumed he lost. The financial press calculated his opportunity cost. The tech podcasts debated his timing. The documentaries framed his exit as a failure of nerve. They measured his decision in dollars, in market caps, in missed exits. They didn't measure it in sleep, in clarity, in the quiet certainty of waking up at 7 a.m. and knowing exactly what you're building and why. Marcus didn't reject $400 million. He rejected a version of success that required him to look away. He didn't abandon the company. He abandoned the compromise. He traded equity for alignment. He traded wealth for coherence. He traded the spotlight for the work. As shown in the 2025 academic conference footage, he stands at a podium in a modest lecture hall, speaking to 200 developers about system integrity. He wears a simple sweater. He speaks without notes. He doesn't mention Axiom. He doesn't mention Julian. He talks about architecture. He talks about consent. He talks about the difference between growth and scale. The room listens. The cameras capture his hands. They're steady. The voice is calm. The words are precise. It isn't a comeback. It isn't a revenge arc. It's a continuation. He's been building the whole time, just not for the people who measure worth in valuations. The final twist isn't hidden. It's documented. It's in the patent filings. It's in the open source repositories. It's in the engineering forums where developers reference his modules as the standard for transparent data handling. It's in the quiet shift happening across the tech sector. Startups are prioritizing explicit consent. Investors are funding privacy-first architectures. Regulators are rewarding transparency over scale. The market is correcting, not because of panic, because of exhaustion, because people are tired of platforms that ask for trust while extracting value, because the model Marcus walked away from is finally showing its cost. Julian's company survives. It adapts, complies. It rebuilds its privacy framework. It hires consultants. It launches new dashboards, promises better defaults. The stock recovers. The headlines move on. The narrative resets. But the foundation remains altered. Not by force, by choice, by the quiet decision of one man who realized that success isn't about how much you accumulate. It's about what you're willing to carry. He didn't miss the IPO. He saw the invoice. He paid it in advance. With $400 million. With a career trajectory. With a name that would have lived on financial tickers. He walked away not because he couldn't handle the pressure, but because he knew exactly what the pressure would cost. And he refused to pay it. Years from now, when the startup books are rewritten, when the documentaries add new chapters, when the financial analysts update their models, the story won't change. The facts are already recorded. The code is already committed. The logs are already timestamped. The separation agreement is already filed. The open source repositories are already mirrored. The academic papers are already cited. The narrative is already complete. 2 founders. 1 company. 1 chose scale. 1 chose structure. 1 stayed. 1 walked. 1 built an empire. 1 built a standard. Neither outcome is superior. Both are necessary. The market rewards growth. History rewards coherence. The algorithm pushes engagement. Time pushes truth. Marcus didn't win by staying rich. He won by staying clear. He didn't lose by walking away. He gained by not looking back. The desk is empty now. The whiteboard is archived. The stock ticker moves on. But the architecture remains. Not in boardrooms. Not in valuations. In the quiet lines of code that prioritize consent. In the systems that refuse to mine what they promise to protect. In the people who still build like trust matters. Because it does. And because one man already proved it. He sits. He codes. He ships. He walks. The ledger records it. The internet forgets it. The work remembers it.